9, 8, 7, 6, 5, 4, 3, 2.
I've recently had a comment on my article. I'm selling USD JPY and buying correlated pairs. And here is how I trading early fundamentals 2 weeks ago. And this AI I was using was called Forecaster AI agent, and I have made a few videos and already published on this channel. So the reader commented, "You believe AI gives you an edge because they called the move before it happened. But markets do not move because a forecast exists. They move because of human action. These are not things that can be modeled by any AI in a deterministic way. What you are doing is narrating price movements after the fact and calling it insight. It's not. It's noise, it's storytelling. And it's the kind that keeps traders poor." That was the comment. That hit deep. And I said I will make or share what I had kept myself, and that is the lessons I had at 2023 with my mentor. And this video is what I'm going to share with you directly from my mentor. It might be long, but it's for those ones who are already serious. So I have two versions. I have this article that I have published on Medium. I will leave the link in the description for you to go and check it out and read everything I've been able to write down for you. This is the whole article explaining how price is formed and discovered, and if AI trading is an illusion or not. And you get more value from this article, I believe, not storytelling, as the comment says. In addition to that, you are also going to get a video alternative on how price is actually discovered, who is the market maker, and you will know the forces of supply and demand, more insights. And let me know what you think at the end of the video, right? So let's go.
How's it, traders, and welcome back. In this video, we're going to be talking about the market maker. In our previous videos, we've been touching on the market maker. In the passive participants video, we touched on the market maker as a passive participant. And in our previous video, we spoke about aggressive participants. And we also touched on the market maker. So we've covered quite a bit of what the market maker does in previous lessons, and it goes without saying that it's necessary, because you really can't have an explanation of one without the other, right? So in this video, we're going to be touching on the market maker alone, right? And we most likely will be touching on other participants as well, right? Because it's necessary in the explanation, right? So the first thing that we know about the market maker is that the market maker is a passive player, all right, within the market. And if you remember, in our previous video, we described them as sitting on the bid-ask spread within the market, right? So if this is your candle, right, your market maker is going to be sitting on the bid-ask spread, however wide that is. Okay, and just a little recap, we identified that the market maker is basically selling on the ask, right, and buying on the bid, right, and the market maker is actually providing liquidity within the market, right? So that's a point that we can write down. Right, and they do this by using sell limit orders, right, that are obviously, as previously stated, on the bid ask, right? So they'll have sell limits, right, on the ask price, and buy limits on the bid, right? So if an aggressive participant, right, comes in and executes at the market, right, and basically buys now, okay, so they pay up the spread, okay, they basically are filled, right? A buyer would be filled at the ask price, right? And likewise, the seller would be filled at the bid price, right? And as discussed in previous videos, right, the market maker will make profit by buying low and selling high. Okay, so it'll buy from any sellers willing to pay up this price, right? And then it'll sell to any buyers, right, willing to pay up this price. Okay, and that basically gives them a profit, right, equivalent to how wide the spread is, right, in terms of pips. Okay, now also just a brief overview, right? We also know that the market maker is capable of withdrawing this liquidity, right? So if we got a lot of aggressive buyers coming into the marketplace, okay, and we do not see any aggressive selling coming into the marketplace, the market maker is basically gonna withdraw its sell liquidity, right? And it's going to move this liquidity higher, right? And it does that in order to protect itself, right, from these aggressive buyers that are coming in the marketplace, right? It doesn't want to fill that position, right, at this price. Okay, so it's going to need two-way money, right? Remember, in our previous video, we spoke about that idea of two-way money, right? The market maker is going to need both sellers and buyers at a specific price so they can buy from the sellers and then sell to the buyers, right? And that initially helps them stay market neutral, right? They don't have to worry about direction, and they can basically buy low and sell high, right? But if that volume is not present within the marketplace, right, and we have a situation like this hypothetical one we are speaking of now, right here, right, whereby we have a whole lot of buyers within the marketplace and we have no aggressive sellers coming in, right? The market maker basically has no volume or liquidity, right, to pair up, right, this buyer with the seller. Okay, so what the market maker is going to do is he's going to put the odds in his favor, okay, and he's going to withdraw his liquidity, right? He's not going to sell to this buyer at this price, right? He's basically going to move the liquidity, right, to a higher price, right? And basically he's going to move the liquidity to an area where there are sellers within the marketplace, right? And by doing so, right, this is what generally moves price higher, right? When the market maker moves its liquidity, right, the candle prints behind that withdrawal of liquidity, and the market maker is essentially moving its liquidity to an area where it can find sellers, right, to pair up with these buyers that have come in, right, and they get filled at that price, right? At this point here, the market maker can basically buy on the bid and sell on the ask, right, and make that profit, right, that spread. Okay, and we went over the fact that this is how the candles are actually printed within the marketplace, right? So another thing we can put here, right, and a very important point is that the market maker needs volume, right? Right, the market maker is always searching for volume. Okay, and it's doing this because it's in areas of high volume that the market maker is able to take a lot of trade and make profit, right, by matching up buyers and sellers, right, buying low and selling high using its bid-ask spread. Okay, so it's always searching for volume, and that brings us to a interesting topic, right, and a very important one, right, and that's basically price discovery. And we can actually write that down. And initially what price discovery is is basically the search for balance within the marketplace, right? And that would be obviously a range or two-way money, right? And this is what we're going to be explaining today with regards to the market maker, right? And if we just get into this really quickly, okay, right, initially we can start off with a balance area. Okay, now this is an area where we have two-way money, right? And that's because supply equals demand, okay, in the marketplace, and the market is basically in an equilibrium. Now we will obviously have our passive sellers sitting at the top of this range, okay, and we have our passive buyers sitting at the bottom of this range, right? And possibly some aggressive traders in between, right, buying and selling within this range, okay. And the market maker in this area is generally happy because there is high volume within this area, right? So this is basically a high volume area, right? We have a lot of buyers and a lot of sellers within this area, within this range, right? And the market maker is able to buy and sell from all the participants, right, in this area. And it's beneficial because all this volume is located in an area, in one specific area, and price is not trending, okay. So the market maker doesn't really have to worry too much about the risk, right, of having to withdraw its liquidity, okay, because we have too many aggressive buyers or sellers coming in the market, okay, and a lack of selling as well, right? So it doesn't have to worry about the risk of this imbalance, right? And this is generally where the market maker makes its most money, okay. Now there's going to come a point where all the liquidity or trading activity in this area is basically going to dry up, and that's going to come at a point where all the liquidity is matched, okay. So meaning all the buyers have paired with all the sellers, right? And we have no new selling or no new buying coming in the market, right? And let's say that we have 1,000, right, limit orders sitting on this area, right? And let's say we have 500, right, limit orders sitting on this area, okay. Now obviously it's going to be more difficult to get through this level, right, because that would mean that we would need 1,000 sellers at this price, right, in order to absorb this liquidity, right, and that would make this level disappear. In contrast, right, we only need 500, right, orders at this price. So if price is at this area, we need 500 buyers to come in and absorb these passive orders, right, and at that point, okay, these guys disappear. So if that's the case, right, it would be much easier, okay, to take out this side than this side. However, that doesn't mean that price can't break down, because if we have a lot of sellers coming in, right, and those sellers overwhelm the buyers, right. So for example, if in this whole range at this top edge we've only had, let's say, 100 buyers coming in, right, they would not absorb this liquidity. However, if we had 2,000 aggressive sellers at this location, right, they would basically consume this liquidity and price would then move lower, right. But it does help, right, if one side of the market, right, is thicker than the other side, okay. And it's more the idea of this that's important, right. If we have less limit orders, right, at the top edge, it would generally be easier for price to move through the top edge, okay. And obviously once this liquidity, if we assume this liquidity has been consumed, right, and we can assume some of this liquidity has also been consumed, and we can argue and say that hypothetically maybe we have 200 buy limits left here, right, and at this area we have 0 buy limits left here, right, and price is all the way up here at that point, right. At that point all it takes is one buyer to come in the market, right, and no new selling to come in, right, and what's gonna happen is price is gonna break to the upside, okay, and trend. Now at this point the market maker obviously withdraws its liquidity, right, from the market as well, okay, and that allows the candles to increase in its range, right? So if you think of the market maker withdrawing its liquidity, right, it would form a large candle to the upside. Okay, if we had a buyer at this price point and we didn't have any sellers, right, the market maker would then withdraw its liquidity to an area where we can find sellers at higher prices, and obviously that's going to drive or print the candle to the upside. Okay, and that's going to create a long-ranged candle. Now, in contrast, let's say we have a buyer at this price, whatever price it may be. Okay, we can assume it's the same price as that price there, right? So we have a buyer at this price. Okay, and let's say we do have a lot of volume within this level here, right? Whatever prices these are. Okay, let's say there's a lot of liquidity at these prices. Okay, hypothetically, right? So within this range, right, we have a lot of liquidity or volume in that area, right? What's going to happen is that when this buyer comes in at this point, right, these sellers, right, because there's a lot of buyers and sellers in this area, these sellers allow the market maker to pair up these buyers, right, with the sellers. Okay, and that means that the market maker can gladly do business in this location without having to withdraw its liquidity to higher prices, right? And if we just argue and assume that we have, let's say, on this example on the right, let's say we have 50 lots of buying coming in, right? And in this area here, we also have 50 lots of buying coming in. And let's say that there is the next level where we have sellers. Let's just hypothetically say is this area, right? Now at this area, maybe we have 100 lots of sellers, right? And because there's no sellers in this location or in any of these locations, right, for it to fill this 50 lot buyer, okay, the market maker is going to withdraw its liquidity to an area where there are sellers, right, to match up with these buyers. Okay, now obviously in the market, right, at every price point there'll be some sort of liquidity, okay, and in very liquid markets there's a lot of it, okay, but this is just to explain the point, right? Now if we come here to our right hand side, right, let's say at this level we have a 50 lot buyer, and let's say the next level, right, of selling, right, is this level as well, right? So in that area, right, just within this region, right, there's a 50 lot seller sitting at this level, right? And that means that price only has to move up to this level, right, for the market maker to find a seller to pair up with this buyer coming in the marketplace. Okay, and therefore we have, in this scenario, what we have is a very squat candle, right, with a compressed range. Okay, right, in comparison to the candle on the left. Okay, now in these two examples you can see which candle produces a trending condition and which candle produces a more lethargic or choppy condition, right, or a more compressed condition. Okay, so having said that, right, coming back to what we're talking about here on the left, right, when this liquidity dries up in the marketplace, right, and there are no more buyers and sellers within this range, right, the market maker is then going to withdraw its liquidity, right? And if we have overwhelming number of buyers coming in, right, aggressive buyers coming in, right, after all this liquidity has dried up, right, if this liquidity hasn't dried up, any aggressive buying coming in would just be absorbed by these passive sell traders, right, and price wouldn't go anywhere. But now that they are done with, right, these guys are now out of the market and there's zero sell limits above price, okay, and we got new aggressive buyers coming in, okay, the market maker is then going to withdraw its liquidity, right, to an area where we can find new selling, right, to pair up with the aggressive buyers coming in. Okay, so that's going to allow price to break out of the range, and what we are going to get is basically a trending move, right, and that trending move is going to stop when a willing market participant, right, steps in front of the train, okay, either in the form of sell limits, right, or aggressive sellers, okay, and they can jump in for whatever reason. Maybe they think price is overextended, right, maybe it's a fundamental issue, or whatever the case may be, but price is going to trend to the area, to the next level where it can find volume, right, or two-way money, okay, right, so it's in search of balance, okay. And the fact that we have found balance at higher prices means that on a large scale, right, what this means is that we are still getting a whole lot of buyers at higher prices, okay. Now it's important to note this because it's natural to find sellers at higher prices, right? Because as a price of something goes higher, right, it's more beneficial to sell. If you just think of you as a business owner, right, if you own a product, it's more beneficial for you to sell that product at a higher price. Okay, but it's not beneficial for your customer, right? If that price is high, your customer is basically not going to be interested in buying that product. Okay, so as price is going higher, right, these buyers are basically the customers. Okay, and these sellers are basically the owners of the product, right? If price is going higher, and it's more beneficial for sellers to sell at higher prices. Okay, so there are always going to be sellers, right, ready to sell at a higher price. Okay, but as for buyers, right, as price goes higher, our customers over here, right, they're going to be less and less interested in buying as price goes higher, right? But as long as we get this two-way money, right, this tells us, right, that we do indeed have buyers at higher prices. Okay, and that's quite obvious because if we didn't have these buyers, okay, price wouldn't be ranging. Okay, price wouldn't be ranging. Now, the fact that we are creating a range at new highs, right, and we have buyers at higher highs, it means that price will most likely go higher, right, to test, right, if we have more volume at higher prices. And this will typically happen because the market maker can sense that we have buyers at higher prices coming in. Okay, and because of this, it'll want to take price higher, right? When the liquidity in this area dries up, it'll be more beneficial for it to take it higher to search for new volume at higher prices. So when we generally see these buyers coming in at higher prices, and all this means is when I'm saying buyers at higher prices, it means we basically have a range building above the previous range. Okay, and that basically tells you, right, that we have buyers coming in at higher prices than we previously had, right? So obviously these buyers are coming in at a higher price, right? These buyers here are coming in at a higher price than these buyers. Okay, so that basically means we have buyers at higher prices. And that gives you a clue that the market maker is most likely going to withdraw its liquidity to the upside, okay, in search of volume at a higher price. Okay, because it's more likely to find that volume at a higher price because that's basically what's been happening. Okay, we've been getting these buyers at higher prices, right? So it's going to assume, right, that that volume is going to be available at higher prices. So it'll take price higher in search of new volume or new balance, right? And that's basically the price discovery process. Okay, and it will keep doing this until a point where we don't get any new buyers at higher prices, right? And at that point, right, what we will see is a rejection of the previous high, right, and price will trade back within the range, right? So typically what's happening in here is one of two things. Okay, the first thing, right, is that we may have, right, is exhaustion, right? And basically what this means is that we have no new buyers at higher prices. Okay, and what that does is that when price trades higher, right, we may find sellers, okay, who absorb at higher prices, and maybe we get aggressive sellers selling in this up move, right? So we have some sellers, right, sitting passively or entering aggressively as price goes higher. Okay, but what we do not have is buyers, right, at these higher prices. You might find a few buyers, okay, but the sellers are overwhelming the buyers, right? And typically these sellers absorb all the little buying that comes in, right? And if no new fresh buying comes in the marketplace, okay, then price can't trade any higher. Okay, and at this point it's quite clear, because at this point, let's for argument's sake say let's say you have 10 lots coming in there, right? And then you have a 10 lot buyer coming in there, right? And let's say these sellers, you have a 2 lot coming in there, right? So you have some aggressive selling there. As we go higher, let's say you got a 4 lot coming in there, right? 4 lots of aggressive sellers coming in. Can I just change the color, right, so we can see that clearly? Right, let me make that orange, right? Then we got a 4 lot coming in there, and then let's say we got 100 lots passively sitting at this area here. Okay, so it's quite clear that if we match up these aggressive sellers with these aggressive buyers, right, we have a surplus of 8 buyers at this price point, and then at the next price point we have a 4 lot of selling coming in and a 10 lot of buying coming in, plus the 8 lots that wasn't filled at this point, right? So at this price point now we have 18 lots of buyers at this point, right? And we only have a 4 lot seller coming in, right? At this point in time, right? Only 4 of these lots full 18 of these full 4 of these 18 buy lots, right? These 18 buy aggressive orders, right? And we'll be left with a situation where we have 14, right, lots still on the buy side, okay, after pairing up these sellers with these buyers. Okay, so we still have a surplus of 14 lots worth of buying coming in the marketplace. Okay, so it's still quite clear that at this point, obviously the market maker is gonna withdraw its liquidity to the upside at this point, right? And then we hit this brick wall. Okay, and basically this is 100 lots worth of selling, right? They absorb this 18 lot worth of buying. Okay, so when this happens, it's quite clear that these passive sellers are going to absorb these 18 lots of buying, right, at this point. Okay, and what we are going to be left with is 82 lots worth of passive sellers, right, still sitting at this level. Okay, now firstly, you can see that the volume that's actually taking place, or the trade that's actually taking place, is very low. Okay, and let's say no new buying comes in at this point. Okay, then what's going to happen is that the market maker is basically going to detect, right, that there's no new buyers in the market, right? So if we have no new buyers at higher prices, right, that means there's basically no volume taking place at these higher prices, right? So it's going to trade lower, it's going to rotate the market lower back to an area where there was previous volume, right? And that will be in the previous range, and it will do that in search of two-way money. Okay, now because initially this volume that was in this range, right, has obviously dried up because price broke out of that level. Okay, and if we have no new buyers stepping in at this point, right, then price is gonna have no choice but to rotate lower in search of buyers at lower prices, right? Because we initially couldn't find buyers at higher prices, so we must now find buyers at lower prices. And once we do that, right, once we find those buyers at lower prices, right, we anticipate seeing sellers now coming in at lower prices. Okay, and if we see sellers coming in at lower prices, right, then we have a very good idea that prices are probably going to be trading lower or trending lower from this point. Okay, so that would be an example of exhaustion. Right, and that's basically a situation whereby volume dries up, right? Right, so there's no new volume at these higher prices, right? So price must trade low to find new volume. Okay, in search of new volume, right, as part of the price discovery process, right? And then the second example, right, the second situation that could occur is basically absorption, right? Now, absorption would be a situation where we do have buyers at higher prices. However, right, the selling that's coming in, right, is just too great. Okay, so let's say we have 1,000 orders coming in, right, on passive orders, right, at this price. Okay, and the buying coming in it's decent, right? However, the buyers cannot absorb or consume this liquidity. Okay, and they end up giving up, right, and price ends up rotating lower, right, because these buyers basically capitulate, right? These buyers end up giving up their position, right, and when they close out their position, right, that's gonna basically drive price back lower. Okay, so exhaustion is basically a situation whereby there is no new volume coming in the market, right? So at higher prices there's no new buying coming in, or at a lower price there's no new sellers coming in, right? And absorption is basically a situation whereby buyers at a high price are failing to take out a level, right, because of the passive traders that are basically absorbing the other side of their position, right? So this is, as previously mentioned in our previous video, this is the brick wall, right? And in order for price to break above this brick wall, right, there needs to be enough aggressive traders that can absorb this position, right, to consume this liquidity, right? And when this liquidity is consumed, price is then able to freely move through, right? But in the case of absorption, right, the passive orders in the market, right, are too great for the buyers to fully absorb, or every time the buyers do absorb these guys, right, they end up refreshing and putting more limit orders in that area, okay, to absorb any buying coming in, right? And they do that obviously to accumulate a short position, okay. And when that happens, right, these buyers have to make a decision to keep on buying up or to exit their position, because they just can't break this wall. And when they exit their position, right, they basically have to sell, and that's gonna cause price to trade lower. Okay, so two different situations, right, but similar outcomes. Okay, all right. So essentially, when we are looking at the market maker, what we need to know is that the market maker likes volume and generally moves from volume to volume, right? Because that's where it can facilitate trade and make money. And essentially that's part of the price discovery process, right? When the market maker wants to protect itself, right, it's gonna withdraw its liquidity, and that's gonna allow price to trade higher or lower, right, in order to search for volume so it can facilitate trade. And then in terms of reversals, which come in the form of absorptions or exhaustions, right, when price exhausts or gets absorbed, right, either to the high or the low, right, that's a situation whereby in the case of exhaustion, right, in terms of the buy side, okay, price trades higher and we don't find any new buying at higher prices, so the market maker must then rotate price lower in search of new volume, right? And in the case of absorption, right, that's a situation whereby we do have buying coming in, however the passive participants are absorbing all the buyers coming in, and that causes these aggressive buyers coming in to end up capitulating, right, or giving up, right? And when they do this, they actually have to exit their buy positions by selling, right? And that aggressive selling causes the market maker to obviously withdraw its liquidity, right? And that causes price to rotate lower as well. All right, so how can we utilize this information? Okay, so we're just going to go over that now. Now, let's for instance say that we are in a downtrend, right? We can use the downtrend today. Okay, let's say we have our balance area. Now let's say price breaks out of this balance area. Now we know that we previously had volume at this level, okay, and let's say price is now balancing at lower prices, right? You see that consolidation coming in, right? This lets you know, right, that we have sellers at lower prices, right? And preferably we want to be trading to the sell side. Okay, so the first thing that we need to identify is that we have a double distribution, right, lower. Okay, so we got this distribution, right, and this distribution, so we got a double distribution lower, right? And this basically is the initial direction that you want to be trading in, right? In general, you want to be trading in the direction of the previous distribution, right, relative to the current distribution. So if we had a distribution right above this distribution, so if we built a distribution in this area, right, in general we want to be buying, right? But because we have a distribution below the previous distribution, right, we want to be looking for selling, right? And this is our first clue, right, that lets us know that we have passive traders and sellers at lower prices. So we know that the market maker is most likely going to withdraw its liquidity to the downside in search of new selling at lower prices, because that's the direction where it's currently finding volume. Okay, and what we generally want to look for is accumulation, right, of these passive traders. Okay, right, so we want to see price breaking out of the range, right, to the upside. Okay, and this will create obviously an influx of buying, right, because it's a breakout, and stops are getting triggered in these locations, right, for traders trying to enter early, or any traders keeping their stops above the high, right? These stops are going to get triggered, and that's going to allow passive traders to basically accumulate their short position, right, in this area. So they will have basically their sell stops, right, sitting around this area, right, and they will be able to absorb any buying coming in, right, and that will basically allow price to, or cause price to rotate back into the previous range, right? And what we have basically is an absorption, right, of buyers at higher prices, right? And this could also be an exhaustion, right? Because if price does break out of this level, right, and we don't get any new buying coming in, right, in this location, right, any selling is going to overwhelm, right, the little buying coming in, right, and any passive traders, right, sitting above price is going to stop price from moving higher easily, right? So you could have absorption or exhaustion within this zone, right? And this is our clue, right? If I just do that in green, right, just go back and remove that. Okay, this is our clue, right, that we should be selling. Right, when we see this exhaustion print, because it tells us one of two things. The first thing that it tells us is that we may not have buyers at higher prices, right, and that's why price is rotating back inside the range. The second thing it's telling us is that we also have trapped traders, right? So anyone that did try and trade the breakout of this range, right, is now trapped when price returns back into the range. Okay, and obviously these traders are going to have to capitulate or give up, right? And when they give up, right, any buyers that are trapped are going to have to sell within this location, and they're going to become unwilling sellers at lower prices, and that's going to help price drive lower. Okay, and in terms of the market maker, right, this rejection, right, tells us that the market maker, right, is based on the information that we have about the market maker. It tells us that the market maker is not finding volume at higher prices, right? So if it's not finding volume at higher prices, it's obviously going to go and search for them at lower prices, right? And that's probably going to be below this range, right? All right, and the same is said for reversal trades, right? So this would be a continuation scenario, right? And for example, if we do have volume at lower prices, right, and we know that price is most likely going to trade lower, okay, when we do get that initial move lower, right, and the same thing that we explained in this area, right, happens in this area, right? So we either get exhaustion or absorption, right, and that's going to be representative of price returning back into the range. Okay, and we either have exhaustion or absorption there, and we also have trapped traders, and we know that the market maker is not finding volume at lower prices, so it's probably going to go and search to find volume at higher prices. Okay, so we can anticipate, based on the price discovery process, price to trade higher, right, in search of that volume, right? And that's basically what trap traders look like, and these are basically your clues for entering, right? So obviously we'll get into this more, but your entries will basically be in these locations, right, in these areas where we get these trap traders. Okay, you'll be looking to enter in these locations, right, in these locations. Okay, in the direction of the double distribution, right? So when you get two distributions down, that's basically a double distribution down, and when you get two distributions up, that's basically a double distribution higher, and you always basically want to be trading in the direction of the double distribution. And obviously that's because the market maker is most likely going to withdraw its liquidity in that direction. Okay, so that's basically the way we use that information, right? And we can see that passive traders, aggressive traders, passive traders and aggressive traders play a huge role, right, in our understanding of how the market works and moves, and how we can actually take advantage of how all these market participants are behaving, right? When we understand what they are trying to achieve, in order what their goals are and what they are trying to achieve, right, we can then take advantage of the activity when we see it in price action, and we can actually either trade with them or trade against them based on what we understand the best probability scenario to become, right? Now, going forward, as we're going through charts, we're going to be speaking a lot about this as I describe setups, explain what's happening within price, right? We're going to be you're now going to be familiar with the language and the terminologies that I'm going to be using, right? And you're also going to be more equipped to see what's happening within price. Okay, so this concludes this lesson, right? And I hope you enjoyed it. And until next time, I'll catch you on the flip side.
So from the video, you learned that the market maker is always searching for volume, and that is two-way money, and that is what we call a consolidation. Now, in this picture or image shared, that is actually a screenshot of AUDUSD on M30. This is what we are calling two-way money or consolidation phase, where we have the supply or seller at the top and demand or buyers at the bottom. And you can see when you see these candles here, that is where the market maker is pulling out his liquidity, is trying to adjust, looking for where there is volume, and this is where there is volume, where he will be able to buy at low prices, but this time it is at higher prices, right? And is trying to meet or pair up all these sell orders up here, right? So if the sell orders are minimum or are less compared to the buy orders here, price will continue to break this one and go higher. So that is the concept. Those are the human actions after AI has given you the insight about what is going to be happening around AUD, that is Australian dollar, versus US dollar. Then you come back to the chart and confluence what is happening using the technical insight. So let me know what you think. Do you think AI is just an illusion, or it is something you should incorporate in your trading?